AMD and NVIDIA declined significantly in the last months. AMD is currently down 45% from their highs in March 2024. NVIDIA, on the other hand, was down 22% from the highs in January. They already bounced back 12% to only negative 10%. This was mainly caused by DeepSeek and the uncertainties caused by the Trump administration. In my latest NVIDIA analysis, I rated the company a strong buy, considering the compelling growth prospects as well as the recent decline. With the very drastic decline of AMD and my strong buy NVIDIA rating, I am going to compare the two companies in this video to answer the question if AMD might also be a good investment right now. Who is leading the AI race? Providing chips for AI applications is the critical business segment for both companies. NVIDIA is currently generating 88% of their revenue in the data center GPU segment, while AMD is doing 50%. AMD's production of the new high-performance MI350 series is planned to start mid-2025 and is backed by strong customer demand. According to the CEO, this new generation is a 35 times improvement compared to existing products. She also reiterated the confidence that the whole AI portion of the business should grow by several billions of revenues in the next years. Meta was using AMD's chips to power their AI Llama model, and Microsoft used this chip generation for GPT-4 Copilot services. Looking at the benchmark of the products, NVIDIA's H100 chips seems to be approximately 7% better than AMD's MI300X chips. Assuming recent GPU prices, this means that AMD is offering a little more bang for the buck. Comparing the AMD Radeon XTX to NVIDIA's GeForce RTX, we get a similar picture. The RTX 4090 is outperforming the XTX by 45%, but customers must pay up to 89% more. When customers decide to spend €2,300 or 156% more for the RTX 5090, they can achieve performance improvements of up to 100%. Due to the software, networking, and infrastructure synergies, NVIDIA is creating full-stack solutions that maximize the performance. These manage to improve the initial A100 chips, introduced 4.5 years ago, by 12 times. This is around 3 times better than Moore's Law would suggest, further emphasizing the importance of NVIDIA's full-stack solutions for AI and the importance of the infrastructure surrounding high-performance chips. To summarize, AMD's chips are less performant than the competing NVIDIA chips. They, however, tend to be the better value, providing more computing power for less investment. Especially NVIDIA's full-stack solutions led to higher performances. While I certainly believe that there is enough room in the data center GPU market for both companies, I think that NVIDIA's position seems to be more favorable. Should the pressure from AMD increase, they could, as of now, just reduce their prices of the high-quality chips to match AMD's less performant ones. Keeping this in mind, AMD could, however, still be an attractive investment considering the decline of 45% over the last months and the lower PE ratio. Valuation. To evaluate the company independently from any peers, I used a discounted cash flow analysis that calculated the required growth rates to justify the current valuation. After that, we will analyze the current business segments and the underlying market growth prospects to see if these growth rates are achievable for AMD. Required growth. Assuming a gradual increase in profitability from current levels to 14% after 2027, AMD needs to achieve growth rates higher than 23% per year to justify the current valuation of $174 billion. Realistic growth rates. The company is mainly offering GPUs and CPUs for data centers and personal computers. Experts predicts the global GPU market to grow by annual rates of 28.6% to 33.2% in the next years. For the CPU segment, studies anticipate growth of 15.2% per annum in the same timeframe. As AMD is increasingly focusing on developing AI GPUs for the data center and client segment, I think it is fair to assume that these growth rates can be weighted by 80-20 to be applied to AMD's growth. This results in a realistic growth rate of 27.8% per annum for AMD. Assuming this rate and keeping the other metrics identical to the first DCF, we get a fair value market cap of $234 billion, indicating that the company could currently be undervalued by 34%. If you enjoyed the video, please consider liking and subscribing to never miss my latest buys. I would also love to know your opinion on AMD. Let's discuss in the comments.